Hello, and thank you for joining us to this first out of three series of webinars. The purpose of the webinars is to demonstrate to you that you can also lead your company to turn your top line sales into your bottom line profits every 3 to 5 years. Yes, really, every 3 to 5 years. So, without any further ado, let's dive into the first of those three sessions. Let's start with definition. The definition of an ever-flourishing company. What is an ever-flourishing company? It's a company that every 3 to 5 years turns its sales revenues into its net profit without taking any significant risk. And in the first time you will do it, even without any additional meaningful cost or investment. This table diagram just on the slide depicts this reality of a company turning top line to bottom line every 3 to 5 years. And this is irrespective of company size, profit margins, or industry. Of course, for companies which are very, very small, in the first cycle, top line to bottom line would be not a challenging enough target to work on. And we'll have to look on the target which is more challenging. So there are only two questions to ask yourself now as we start this journey. The first one, do you think it is possible? Do you think that your company can turn its top line to its bottom line, its current sales revenues to its net profit, not one time, every 3 to 5 years, regularly? If you, at this point of time, think this is ridiculous, I don't understand what I talk about, or it is impossible, don't worry. To begin with, many believe it is impossible. I hope that by the end of this first session, a little bit of homework you will have to do about your own company, you will come to the confidence that it is possible. And if it is possible, would you be interested in leading your company to such performance levels? These are the two questions you would like to ask yourself as we embark into this journey into what seems to be possible. So these webinars have following objectives. I would like to get to the point that you will understand that not only this performance is possible, it is not as difficult as you might think it is. We will reveal the necessary conditions that you need to meet in order to realize such performance. Why is it possible at all to do that in spite of the fact that there are not too many known examples of such performances? What knowledge you will need in order to make it happen, and what process can you follow to make it happen for your own company? Just so we feel a bit confident about why can we talk about it, I'll give you a little bit about myself. I've been, for the last 35 years, in the management consulting industry. 20 years of these 35 years, I was working hand in hand with Dr. Eli Goldratt, the initiator of the theory of constraints, and I was responsible for developing the body of knowledge and disseminating it across our consultants globally and our customers everywhere around the world. For 6 of these 20 years, I was the CEO of Goldratt Group. Those logos in the bottom of this slide are just some of the customers I've personally worked with over the years, implementing different theory of constraint solutions, some of them even the same exact one we are going to talk about today. I just want, before we jump into that, a small warning. Top line to bottom line in 3 to 5 years is doable, it's possible, and I'm confident you will gain this confidence as well by the end of this webinar. But sometimes, some companies, in some cases, cannot achieve this level of performance. And on those cases where top line to bottom line in 3 to 5 years is not possible, still following the process we would be drilling and discussing over the next webinars is going to deliver exceptional and sustainable performance, which is way above industry standard performance. So maybe not for everyone top line to bottom line, but even if it's not, way above the normal expected level of performance within an industry or a geography or both. So just start with an example. Take an example of a company called Elwood City Forge. And this company is a leader in open die forging. They forge out of different metals, different products. You can see some of those pictures around down at the bottom of this slide. However, it is important to emphasize that many of those products are long processing time in production, a lot of metallurgy, so heating, cooling, and some of them are huge in size, which makes transportation a very limiting factor on the geography of performance or where they can operate in. Just before we have been working together, the company was doing 200 million US dollars a year with about $10 million of profit, about 800 employees, with 2 sites in Pennsylvania. Most of their market was very close to their factories, given the cost of transportation. And surprisingly, they were starting to be negatively affected by competition from China that was subsidized by the Chinese government and was able to arrive, in spite of transportation costs, to the US with prices which were lower, practically lower than the cost of the material Elwood was using at that time. So we developed, together with the top management, a new strategy, which we call a viable vision, to become an ever-flourishing company. And you can see here, we're not going to go into these details right now, but you can see that this strategy has 2 arms. One arm called base growth, and it says over there, I hope you can read it, reliability, competitive edge. And there is an enhanced growth, which has rapid competitive edge. So if you go to Elwood City Forge website, you will see on their page that there are 2 elements that appear over there for many years now. One is called superior unit performance, and the other is called rapid lead times, the 2 branches of the strategy that you just saw in the previous slide. So what happened within, unfortunately, a little bit more than 3 to 5 years? In the first cycle, it took a little bit more, 6 years, but here's what happened. You can see the red line showing the growth in sales, basically, new orders the company was receiving, and in white, their shipments. And you can see on this right side, the blue line depicting their improvement in on-time delivery. This is on a it looks big graph, but the time between the 56% and then 96% is just a few months. Within 6 years, the company reached a level of sales of $725 million, but with $210 million of profit, grew its employees and its operational expenses, of course, went in a very interesting way, is able to sell beyond the geographic limitation it used to experience in the past, even actually all the way into China. Elwood is not the only one. Implementation of theory of constraints. You can see on the left a book called The World of Theory of Constraints. It is an independent survey that was done by a professor called Victoria Mabin. She researched 86 companies globally implementing theory of constraints. You can see the graph on the left showing the average results those companies were achieving. See average reduction of 70% in lead time, an average increase in financial performance of 73%. The left blue graph and the right green one, just to choose 2. Another research that was done many years ago, led by the Chamber of Cost Accountants in the US, came to the conclusion to mimic Alex Rogo. Alex Rogo is the hero of the book The Goal, to those of you who have not read yet. Mimic Alex Rogo's actions in The Goal. These efforts usually will be rewarded with almost immediate improvements in operations and in profits at virtually no cost. The graph on the right-hand side are the average results of the customers I've been working with over the years. Just not to stay with one example, let's add a few more. Tata Steel, one of my customers in the past, that grew its net profit from 5 to 30% in 4 years. This is in a best commodity industry, a project that other people led with a company called AECI, that grew its net profit by 1,000% in 5 years. It is a significant increase, right? Premier Foods that grew its value by 7,300% in 7 years. And Fleetguard, which was an exciting learning for us, as they've done it all by themselves and were able to do for the last 10 years, top line to bottom line 3 times. So a demonstration that is possible even faster than once every 3 to 5 years. So just a few examples of what is possible to achieve. So what is actually needed to make it happen? To be able to answer that, we need to, first of all, change a little bit our financial point of view of company's performance. Normally, our profit and loss statement look like the following example. If your sales revenues are 100, you will then deduct from it what is called cost of goods sold. Normally, cost of goods sold will have the following entities comprising the final number. It will be opening inventory minus closing inventory. For the sake of this example, I chose to have both of them at 30, so inventory will not affect profit. The actual cost of purchasing done throughout the period, plus what is called direct labor. So 45 for purchasing, 25 for direct labor. Total cost of goods sold is 70 because opening inventory 30 minus closing inventory 30 gives us a 0 effect on cost of goods sold. 100 minus 70 gives us a gross profit of 30. All the rest of our expenses are 25. We call them operational expenses, leaving us with a net profit of 5. So what's wrong with that? This is a very misleading presentation of the financial performance of a company. And why is that? A few reasons. One reason is because changes in inventory inaccurately affect profit. So if, for example, opening inventory is 30 and closing inventory is 40, then 30 minus 40 is minus 10, gives us a cost of goods sold of 60 and a gross profit of 40. So we created an artificial profit just by inflating our closing inventory. It's not real profit, it's not real money we make and we take to our bank. Actually, it is so artificial that it can get you bankrupted because you use real money, cash, to buy materials, produce them, and make them into stock which is lying in your inventory and not selling it. So it is distorting the profit point of view and decision making. The second problem is we take direct labor and we treat direct labor as if it is a variable cost. It is not a variable cost. It is a variable cost. All cost is variable, but it's not what we might want to call as a truly variable cost. If you have 25 people in your production and you lay off one of them, you will not lose the capacity of producing one unit. And if we recruit another one person, you will not add capacity for production and selling of one unit. It's not linear, it adds or subtracts your capacity in a chunk, in a quantity, not in one piece. But if you use or treat it as variable, it gives you the feeling or the index that is showing you a change in cost by one unit, which is distorting again your decision making and your financial point of view. As most of the cost, as I said, seems to be variable, it seems that any change in quantity is changing the cost as well. In that sense, you would think that in order to, if you have a 5% net profit today, 5 after 100, if you want to get to 100 as a profit, which is 20 times the current profit, you will have to 20-fold your sales as well, as all costs seem to be linear. But this is not the case. So you gain part of your perception that it is impossible to turn top line to bottom line because you have this linear connection in your hand. Every additional 1 unit sold will linearly increase our cost as well. The truth is that costs look like this. Some costs are truly variable costs. They really change with every unit you sell. So if you look at raw material, for example, if you sell one more unit, you will consume one more unit of raw materials. If you did not sell it, you will not consume it. This cost is truly variable. It changes by the unit. Well, other expenses do not change by one unit. They change by some form of a step function. The common P&L practice assumes that if we are here in this point, then we can add this number with that number divided by the quantity and get cost per unit. Of course, then we will use it and say that if we sell one more unit, cost will go up. But as you can see, all of this area means the cost will not go up. So it gives us a distortion. To overcome this distortion, there's an alternative view on the financials. We look at sales, the same 100, deduct from it the truly variable cost. Normally, raw material, sales commissions are truly variable costs. And we get throughput is actually the money we've been able to make. This is our money. In this case, we did sell 100 and we collected 100 from our customers, but 45 of these 100 we collected and we paid to our suppliers to finance the materials, the sales commissions. And therefore, what we really made is only 55. All the rest of our expenses, including what is direct labor and indirect labor, is 50, leaving us with the same net profit of 5. So a bit of a different point of view, where the truly variable cost is 1 and the operational expenses are all combined into one number. It will give us a much better ability to evaluate what is needed to do in order to turn top line into bottom line. So now that we have this alternative point of view, we can ask ourselves, what would it take to reach this level of performance? How much more do we need to sell so that we can convert our 100 top line to a 100 bottom line? So the necessary condition, there is one critical necessary condition, is that we must find a way to grow sales at a faster rate than the rate we would grow cost. Yes, in order to grow, cost will have to grow as well. However, it should not and cannot grow faster or even at an equal pace as the pace that we are growing, the pace we are making money. So this is not a solution yet. It's just to draw the picture and see what happens if I take two extremes. One extreme is what needs to happen. How much more do we need to sell to have 100 profit if our strategy is solely dependent on growing our sales of existing product with existing prices, no difference in that. So in this example where the net profit is 5%, we will have to triple our sales to add 200% to our sales. If we sell 300, variable cost will be 135. Our throughput will be 165. And if we can do it while at the same time we grow our operational expenses only by 30% from 50 to 65, then our net profit will become 100. If we are successful in achieving that level of performance, we are also successful in improving our valuation of the company 31 times, from 25 to 800. Yes, if you are able to realize such level of performance, the financial market will reward you with a higher PE ratio than the standard of the industry. The second extreme says, hey, we are only going to achieve that just by increasing our prices. We assume, of course, it is possible. So if it was possible, then it will be enough only to double our prices. Because the 100 will become 200, the variable cost will not change because we are selling exactly the same as we did before, only for a higher price. Give us 45. The throughput becomes 55. And even though there is no reason to increase our operational expenses, even with a slight 10% increase in operational expenses, our net profit will become 100. And having such a high level of net profit, 50% out of sales, the financial market will reward us with even a higher level of PE, which will bring our company valuation to be almost 40 times greater than it was 3 to 5 years ago. So these are the extreme scenarios. Normally, we don't have the ability to execute a strategy which is like that. So what would we do? Is we need to find a way that in the next 3 to 5 years, we will double our selling prices or triple our sales while increasing costs slower and without taking any significant risk, or a strategy which is a combination. So some increases in price and some increases in sales. Of course, you might ask yourself if it is at all possible, but the important thing that you learn here is all we have to do is somewhere between doubling to tripling our sales in order to get to 20 times our net profit. Okay? It is not as big as a challenge as you might have been thinking just a few minutes ago before this webinar started. So, what are necessary conditions that must happen? The first one is that there is a big enough market. You can't grow your sales twice or 3 times if there is not enough market. The market should be big enough so you can do it not one time, but more than one time. So this is the time for you to start evaluating the applicability of what we talk about to your own company. Try to answer the following question. What is the total relevant potential of buyers for your products or services in all relevant geographies? What do they all represent in terms of annual purchasing potential of your products and services? Then ask yourself, what is your current share of this market? How much you hold out of this market? And then lastly, how big is the gap? If you find that the gap is not huge, then you will have to work on identifying effectively your market. Otherwise, I assume that for most, we will find that the difference is just very, very, very big. If it is very, very big, then there are a few conclusions that you can come up with. The first one, the market is not concerning your performance. There is a big enough market. What is constraining your performance is your ability to continuously grow your sales in a rate which is greater than the rate of growing your cost within this market. The interesting thing, if you look at what you are doing and what your competitors are doing and what most companies in the world are doing, they are operating as if the market is their constraint. And if the market is the constraint, then you have to make the market bigger. How do you make the market bigger? New products, new markets, and of course, cost-saving initiatives everywhere. These are the 3 main ways we are trying to deal with when the market is the constraint. But if the market is not your constraint, then all of these initiatives will have a limited, if at all, effect on your performance. Instead of what you should really do is focus on how do I increase my sales with my existing products and my existing capabilities. So we have identified that the first important condition, necessary condition, critical, is we operate in a big enough market. But then the second one maybe it might be a bit surprising. What we need to do in order to achieve such level of performance as top line to bottom line every 3 to 5 years is to improve our productivity. And in two periods, now and in the future. Now, in order to improve our productivity, we need to make much more money without any additional cost. And once we have exploited all of our potential of making money on the existing cost infrastructure, we have to find a way to keep growing our productivity through growing our revenue generation in a rate which is faster than the rate we will grow our cost. As a measurement, we are measuring productivity as the money you make, throughput, divided by the money you spend to that end, your operational expenses. Throughput can grow faster than operation expenses in the following ways. First, if you currently have backlog demand, if you are able to produce more with the same resources, this additional productivity will immediately turn into additional revenue generation by simply delivering the backlogged demand. Then we want to increase sales with existing prices and delivering them using the same resources. So if there is no backlog demand, it means we have excess capacity. If you have excess capacity, we might as well use this excess capacity to sell more without increasing our cost. We want to increase our sales through increasing our prices. Definitely, if you can increase your prices, you will increase your throughput without increasing your cost. And at the end, as life is not only one way of doing things, what we will actually be doing is a combination of all of those three approaches. All of these approaches will be continuously executed time and again to enable this top line to bottom line every 3 to 5 years. So the first thing to do is be able to deliver much higher operational productivity. Use the existing infrastructure, the existing capacities, produce and sell more. And this can be safely realized through the application of the theory of constraints operational solutions. As this book demonstrates, and thousands and thousands of implementations globally, many of them which I have done personally and many which were done by many other consultants and by companies by themselves. The normal productivity improvement ranges between 30 to 100% for any given factor with the same resources. This is the amount of additional productivity you can get. In the next webinar, we will try to build the confidence that it's not just because others are doing that, that there is a reason why you would be able to be much more productive using such solutions. And then to increase throughput from the business standpoint, what you will need is a way to attract the most appropriate customers to buy from you. What you need for this? We need to identify conditions that will drive the right customers to be willing to buy more, pay more, and buy more frequently from you. And then we'll have to make sure that these conditions are executed within your company in a profitable and sustainable way. How do we find these conditions? It requires us to identify something which is critically important to a large enough relevant market. We call it a market significant need. And based on that, define what conditions your company must satisfy in order to meet these needs in a level that competitors are not likely to be able to or willing to commit. If you go back to the Elwood City Forge example, The customers, they buy components that are assembled into larger and meaningfully more expensive equipment. Any delay in supply is a set of major negative effects for the customer. Elwood's due date performance used to be 56%, while the industry norm was 54%, so they were about the same as the rest of the industry. In addition to that, it did happen to them from time to time that customers were inquiring about the possibility to expedite a delivery of an order, get it much faster than the standard delivery lead time of Elwood and its competitors. Understanding this behavior of the market brought us to realize that there are two critical conditions for the customers. One, extremely high reliability of supply. Delays carry disproportional financial consequences on the customer, disproportional to the cost of acquiring the product from Elwood. And the ability to deliver from time to time much faster. Why would customers need this? They would need this because they have an opportunity to sell, which they were not prepared to. And if they will not be able to react very quickly, they will lose it. Given the fact that the cost of what they are buying from Elwood is significantly lower than the price that they are selling, it will tell us that the damage of not being able to get it fast is very, very dear to them, and they will be willing to pay premium for that, and meaningful premium, not 5 or 10%. So based on that, the Elwood strategy, as you saw in their website, was, hey, buy from us. If we give you a committed due date, we will deliver on this due date, or else we commit to compensate you by paying a self-imposed penalty for every day of late delivery. And if you need quick response, we are able to do that as well, but it will cost you. You are making an effort, and it will have an additional cost. And of course, you, the customer, can pick whether or not to buy for the premium price. And obviously, the reliability commitment, even in the rapid delivery times, is still valid. How did we create these conditions? We implemented the theory of constraint solutions for production, supply chain, in their production and supply chain. This enabled them to produce faster, more reliably, and as we said earlier, to meaningfully increase the productivity of the factory. Implementing the marketing and sales solutions enabled us to find the right proposal, value proposal to the market, and bring the sales team to be able to effectively sell value rather than sell a product or a service. And the result you saw, it took them 6 years to reach $200 million of profit from $200 million of sales. So we are coming to the end of our first webinar, and maybe it's a time for you to do some homework. What would like you to do in this homework? I want you to get confident that your market is large enough to enable you to grow at this pace for a long enough horizon. Evaluate your market share. If your market share is very small, then you will be able to repeat these cycles for a long period of time. Take your company financials and restructure them to sales minus truly variable cost. Again, raw material, sales commissions are the prime participants into this truly variable cost. Don't dwell into too much whether any other cost might be truly variable. See how much it is of the total cost, and for this period of time of your evaluation, it will not be a major mistake to add it to truly variable cost or to put it in the operational expenses. And calculate your throughput, calculate your net profit accordingly. Based on this new structure, just create yourself these two extreme scenarios, just increasing sales, just increasing prices, to see what are the edges that your strategy. And lastly, evaluate your current excess capacity. How much more you and your team believe you will be able to sell without adding any additional cost or investment. If you will do all of it at this point of time, you will know that you have a big enough market that allows you to convert your top line to bottom line every 3 to 5 years. You will know that even in the 8 scenarios, the growth needed is not as far-fetched as it may have seemed to you at the beginning of this webinar. And you know that you can improve your productivity at least to the level you calculated. And you might believe me at this point of time and know more in the next webinar, that much more than that, using the theory of constraint solution. And you need to feel at this point of time confident that what might have seemed impossible just at the beginning of this webinar actually is possible and for you. And this might be a very good time for you to take a full assessment. You can do a full professional assessment of your company so that you can get the following benefits. A financial model that will illustrate to you the sales and cost changes that will enable your company to realize the target of top line to bottom line in 3 to 5 years, to validate your market potential, to identify the conditions that will make the right customer buy more, pay more, and buy more frequently. We'll give you the implementation roadmap, the minimal number of changes to enable you to achieve the performance with a minimal risk and the slowest rate of sales, of cost growth. And through our unique workshop, we will help you gain full consensus from your management team that this is the strategy to adopt. Normally we charge 10,000 euros for this process, just for a limited period, just for you, the participants of this webinar. We will be offering it for free. So if you would like that, our consultants will pay your company a visit of 1 day, during which we will collect the necessary data, interview some key functions in the company, do a site visitation. We will then analyze the information collected. And lastly, I will be holding a workshop with your top management to gain the consensus around this strategy. And after this analysis, you will have 3 options. You can decide, like Fleetguard that I mentioned at the beginning of this presentation, continue on your own, take the recommendations, implement. We will be more than happy to see you successful. We'll be even happier if you will share with us your success. You can continue with the educational and auditing support from our side, still leading the rest by yourself, or with the full implementation support. All of these will be your choices. If you're interested, please send me an email, provide the information about your company, your name, your function, your website, so we can get some knowledge about your company now, your physical address and your contact details. And please remember, our offer of free assessment to you is valid from today for 1 week. Call us and take the action. Thank you very much. See you in next webinar.